Hi, Peter Jones, Chartered Surveyor, author and property investor, and welcome to the second in this short series of videos in which we're exploring whether house prices really do double every 10 years. And in the last video I showed you an example of a house in the town where I live, which I know has doubled in value every 10 years for the last 20 years, and so seems to fit the picture. But of course the question is that a bit of an anomaly, or does it show that the trend is true and it's still correct? Well, I thought it'd be good to dig a bit deeper. Now, I'm not a scientist and I'm not an economist and I'm not really a very detailsy person, so bear with me, but I thought it'd be useful just to go into the nationwide house price data, because that goes back quite a long way, and that might give us an idea of how things are going and what the trend actually is, looking at some real raw data. So this is what I came up with. Let me just grab notes. What I came up with is this. Now, I didn't want to go back too far, because if we go back too far then this video is just going to be all about stats and figures. It's going to get very, very boring. So I went back to 1987. And in 1987, according to Nationwide, the average price of a house in the UK, and I'm using the UK average by the way, was just over £44,000. So if property was doubling every 10 years, then we could look at that and we could say, right, if that's 1987, what was the price, what was the average value in 1997? Well, if it was going to double, it should have been just over £88,000. In actual fact though, the average figure, the average price, the average value of a property in the UK in 1997 was £62,000, so lagging behind by quite a way. So if we looked at just those figures, we could say no, it doesn't happen. Property values don't double every 10 years, but wait a second. Because if we then go to the equivalent quarter in 2007, here's what's happened. Now, if it should have been that the value should have been 88,000 in 1997, then the value should have been just over 178,000 in 2007. It was 184,000, give or take a couple of quid. So now it's suddenly jumped ahead. It was behind in 1997, now it's ahead in 2007. What about 2017? The figures I've got available, the last figures are for the last quarter of 2017. Well, if it was doubling every 10 years, then it should be 355,000. What was it? Well, it was 211,000, lagging behind quite a long way. Now, maybe that's not surprising, because obviously there was the credit crunch which is going to hit values. You may argue that it was higher in 2007 because there was the boom. But isn't that true of every property market? Isn't there always going to be a boom and a bust? We know that the property market isn't a straight line. It's not a gradual increase or a gradual decline. What tends to happen with property prices is that they tend to be quite flat for long periods of time, believe it or not, and then they'll jump up or they'll suddenly fall away. It's usually years and years of not a lot happening, followed by short bursts of quite a lot happening, which can be an increase or it can be a decrease. So it's not surprising, looking at those figures, that there's going to be sort of big anomalies when we're comparing it with a doubling every 10 years. So does that prove it one way or the other? Well, probably neither, but let me just throw in another thing into the mix here. One thing we do know is that that was using average prices across the whole of the UK. In different regions of the UK, the property market will have been moving by different amounts. The other thing we can see is, because it's averages, because it's an average, by definition, because if it's an average, it means that half the properties will have performed better and half of the properties will have performed worse. And again, maybe that's down to regional differences. We also need, statistically, and I'm not a statistician, but I can see the truth in this, that we need as much data as we can get, and to look at each individual 10-year period doesn't give us the full picture, because when we jump forward, potentially to, I don't know, 2027, 10 years' time, it could well be that prices have doubled again and more, and although they're lagging behind today, they could well catch up, just as they did between 1997 and 2007. In 1997 they were lagging behind the trend, in 2007 they jumped ahead again, and that's bound to happen, that's bound to be the case. Now, one thing we do know is that if prices are to double every 10 years, it implies a growth rate of around about 8%. So I thought it'd be quite interesting just to see what current growth rates are and to think about this more specifically in terms of actual towns rather than the UK as a whole. So here's what I found. Now, I've got access to data on this from a very particular index, which I think is really, really useful. It goes further than the nationwide index. The nationwide index tends to look at regions and it tends to look at them quarterly, whereas the index I'm going to refer to looks at actual specific towns and cities, and it looks at them monthly. And this is what it's telling us. Over the last year, and these figures are good as at the end of 2017, it's showing us that year on year growth in Peterborough, 11.2%, well ahead of the 8% which will be needed for a doubling every 10 years. Where else? Milton Keynes, 9.4% year-on-year growth, again well ahead of the 8% that's required on average per annum for a doubling every 10 years. Sunderland, there we go, right off the northeast at your peril, 8.8%, again ahead of the 8% that's required. Glasgow, 7.9%, just behind, we could almost argue round it up, there's 8%. Northampton, 7.9%, and so it goes on. Lots and lots of areas in the UK where the growth rate is higher. But it's obviously quite mixed, because there's plenty of areas as well where the growth rate is much lower. So for example, just picking on some pretty depressing stats here, Aberdeen still going down. Well, of course they've had big problems because of the oil industry and the price of oil, which has affected the market, but minus 3.7%. London going down, minus 4.1%. That's obviously going to have an effect. Having said that, London is now already, though, 46% ahead of the 2007 peak. So it's well on its way towards doubling, but we haven't quite done it in 10 years. What else have we got? Many other places where it's sort of fairly middling around about the sort of 4 or 5% mark. Now, just because it's been middling doesn't mean it's not going to accelerate in the future, and for those areas where it's beyond the 8% and higher than the 8% doesn't necessarily mean that that's going to be sustained, and that's probably why the only way we're ever going to be able to see whether this trend is still true is looking at it in the future in maybe 20, 30 years' time and extrapolating it over that time period when we can see the obvious trend. But there are reasons why property prices keep increasing, and in the next video I'm going to go through the reasons why property prices will keep increasing, and it's not just because of pressures of population. By the way, I don't even think that pressures of population is the main driver of property prices, and I'm going to explain to you in the next video. So I'll see you in the next video. Until then, here's to successful property investing.